Good morning. Graeme Marshall, I'm founder and chief executive of FundingKnight. I've been starting and building businesses for 25, 30 years, mainly in the financial services sector, and this one is by far the most fun. Although I spent a year in 2011 building a website, which was probably rather less fun, and started lending at the beginning of last year. Fun enough, the idea for getting involved in lending to businesses came from sitting in angel gatherings and coming across companies who were asking angels for equity, but quite clearly could repay it. Funnily enough, none of those companies got any money from the angels, which I think was right. Let me talk a little bit about the industry and reiterate some of the points that David's been talking about. I'm only going to talk about the lending to businesses, but it's now reached about 600 million. I think it's growing at 200% per annum, roughly. This business in England only started, I think, in August 2010. So it's come from nowhere in this time. And the rate of growth, as David said, is stratospheric. Now, what's supporting it? On the funding side, you start off with 50,000 plus lenders. I mean, I think there's a total of 100,000 who are lending on the consumer side and business side together, but at least 50,000 on the business side. There are other things that are pushing the lending forward, both on the retail side, such as tax breaks. Bringing crowdfunding into ISAs is going to be a major thing, because the difference between going and being able to earn a reasonably good return pre-tax and to earn that same return in a tax shelter is going to have a phenomenal effect on demand. The other thing, of course, are the larger investors who are sniffing around, really, really keen to lend. They want to see more volume. And when we provide more volume, they are going to come in droves, and it is going to drive down the interest rates. The products really started with a vanilla unsecured loan. But you've seen the products diversify. Property products have come in. David was talking about the invoice financing. There will be other products coming in because they're looking, we're looking at the specialist areas of banks where the returns to the banks are disproportionate to the effort, and we actually think that we can reorganize that more simply and provide serious benefits to lenders. So that is going to happen, and you will see FundingKnight being part of that movement in diversification of product. So FundingKnight, what we do is we simply match businesses wanting to borrow money with a whole raft of people who want to lend it. These are individuals. Frequently the individuals who are lending through us are also lending through other platforms. They're familiar with it. But we've also got pension funds, we can take companies, and the size of lenders is clearly going to vary, because we're allowing people to lend £25 upwards. We're offering companies up to £150,000. We need an awful lot of lenders to fill a loan. So we have, in that sense, a lot of high net worth people who come in and put in several £1,000s into each loan. And companies and institutions will come in on the top alongside that. There's room for a very broad church of lenders. When we create a loan, we turn it into very, very tiny units of a thousandth of a penny. That means we are making it tradable. Our loan exchange is absolutely key to our entire business. So we're making loans of up to 5 years but people can go, having bought the loan, they can trade it immediately on our loan exchange. So that gives them liquidity. It also gives new investors access to loans. Typical companies we're lending to are owner-managed. They've been going for 2 years. We want to see 2 years trading. We don't need to see 2 years accounts. We want to see 1 year's filed accounts. They need to be demonstrating some sort of direction of travel upwards. We would expect them to be profitable at the time they're borrowing. I don't mind if they've had a bit of volatility, but they must now be travelling in a general upwards direction. Very often they're coming to us because they don't have lots of property assets to offer as security. We're making unsecured loans, and typically we're going to be making those alongside banking relationships. So they'll have a small overdraft with a bank and a small loan from a bank. They will have given up a debenture. We will be coming in and topping up their funding requirement. We're doing that partly because of speed of access and partly because they don't actually want to disturb the relationships they've got. If they go back to the bank and say, I'd like to double my overdraft, they're going to get, one, the risk that the thing just goes into the mill and gets processed and they don't know where they are, or two, they'll get the whole thing reviewed and the existing facility gets withdrawn. So what they really need to do is to diversify their sources of lending. It makes eminent sense financially. We would expect them to have some skin in the game. So we're not looking at lending to companies with a £5 balance sheet who want to borrow 100,000. We really do expect to see a partnership with the owner of the business. I'll come on to that. And the purpose is generally growth. They've got a new contract, they've got a new business opportunity, they need to take advantage of it, they need to put some cash down now, and they will make the return over the next 2 to 3 years. So let me just give you some examples of companies that we've lent to recently. Here's a company that was lending for a purpose which is not terribly fundable very widely, which is simply they wanted to fit out a new premises for their patisserie. So they got some money from us at 10.5%. Now Planet, I love Planet because they turned down equity because they knew they really needed debt. And they also needed to move fast. They had some opportunities that needed commitments. And they came to us and we told them within a week, yes, we'll get you the loan, provided you produce the documentation within quickly. And 26 days from our first meeting them, they had the money in the bank. And because of the way we run auctions, which are 7-day auctions, they knew when the money went to auction, because all our auctions complete, weight of money wanting to get into companies, they knew they were going to be able to get the money. And not surprisingly, they want to come back for another loan. We do have regular lenders already, although we've only been lending for 18 months. Here is a company that has now taken the third loan from us. Interest rates are reducing from 10.5, 9.7, 8.65, because people build up a track record. Our lender base gets to know it. They've given comfort because they're repaying happily every month. They're doing well. They're delivering on their plans, and these are the sort of businesses we love to support. And those rates go down as the risk goes down. So we're very close to our 100th loan, and in 100 loans, the number of loans made in Dorset is 0. It's a big embarrassment. We made more loans in Scotland and Wales than we have in Dorset. So one of those loans has gone wrong, and it is very difficult to talk about default record when you've only been going for 18 months. You'll have to ask me a bit in 3 years, but I'm going to tell you a bit about how we manage that. The range of borrowers across a wide gamut of industries, turnover anything between 100,000, that's our minimum, to probably about 10 million. Most of them have got 750,000 of net worth, but it can be anything down to about 30, 40, 50,000. Most of them have got 38 pence in the pound of their own assets in the company. And surprisingly, although we're saying we'll take anybody who's been in business for 2 years, the average trading period is 12 years. We've got a lot of very mature companies in there. I tend to take the view that every individual SME is individual. You can't systematize them. You can't just put them through a great big credit evaluation machine and come out with formulae that tell you what the risk is. We've actually got to address each one individually. To do that, we set up a team with an experienced banker and experienced credit team underneath. And the first thing we do is we look at the owner and we look at the track record of the owner. We don't mind if the owner has had a failed business. I mean, an awful lot of businessmen make mistakes, a lot of good businessmen make mistakes, and they learn from them. What's important is how they treated the creditors. Did they actually pay them out? Did they actually work towards it? The people we do not want to lend to are people who've had that in their history and say, do you know what I got away with? So we're looking quite closely also at what's their drawing behaviour in the company. I mean, a lot of companies make 50, 100, 200,000 a year, and they draw it all out. So it just goes to finance the owner's lifestyle, and they're left with a company balance sheet that's got £5,000 in it, and they suddenly say, well, I got a need for money. Can I borrow 100,000? The answer is, from us, no. We're looking for this partnership. One of the things we do in processing information is what we ask for is the last set of filed accounts, management accounts up to 3 months before application, a cash flow for the next 12 months, and we look at the last 6 months' bank statements. One of the things we do when we've got all the information together is we have an interview with the owner of the business. And that is a really important part of the process. In having that interview and just getting a feel for the background and general approach towards business, capability of business planning, etc., we also get their buy-in to the whole crowd lending idea. You are not taking this money from an anonymous institution. You are taking it from a whole lot of people who are entrusting you with their savings, putting £25 or £50 in, and they want the money back. And these people who come on our platform really believe in the crowd lending concept. It's really helpful for us to work with introducers, with intermediaries of a wide range who are perhaps financial brokers, accountants, solicitors, business angel networks, business networks. Because out of these networks, first of all, you have a relationship. There is another relationship which binds the borrower in to understanding what's happening, and therefore I think that really helps securing the repayment of the loan. The other thing the introducers can do, of course, is they can help the borrower put the stuff together to make the presentation go through really quickly, because we can do it in days. And the third thing, of course, is commission arrangements. We appreciate that a number of people don't actually want to take commissions from us for introducing deals. And we're very happy to allow the commission we would pay to an intermediary to his client. That means he's clearly delivering a benefit because he'll have a reduced arrangement fee. Coming on to the investing side, our average gross return of 10.7% at the moment. There are no fees to lenders. We charge all our fees to borrowers. We find that's much simpler to explain. And the money that you're getting is, of course, only on the cash that is invested. So uninvested cash on any lending platform is really inefficient, and it drags down the return. The other thing is, of course, money pledged in an auction is not earning anything unless that auction closes successfully. So we make sure that we have put in place arrangements that mean that every auction we launch is going to close on time, and if you've got in on that auction, you will be earning on day 7. We do that in 2 ways. First of all, we document the deal totally before the auction is launched. And secondly, we have investing support arrangements to make sure the auctions get filled. The critical thing, if you're going to get involved in lending to businesses, is recognizing you have got the counterparty risk, and therefore diversification is really important. We keep stressing that. I don't know whether the fact that 27% have got 40 investments is good or not. I mean, I'd much rather see it over 50%, and that's something we'll work on that. 3 ways at the moment of getting an investment portfolio together. The first thing is just being active on the site, getting into auctions. Some people actually adore auctions. They get addicted, they ask questions to the borrowers, and you can see them frantically bidding at the end, getting the last sort of 2 decimal points out of it. You can go totally the other way and have auto bid settings that simply put the bids into the auctions for you. And the third way is, of course, our loan exchange, which always has virtually everything that's been offered on our portfolio trading in the secondary market. So this is our loan exchange. We will have every single loan listed through a grid system, and then you can simply filter out what size loan, what size investment you're looking at making, what risk rating you might be wanting, what minimum interest requirement you've got, and then the thing will simply zone in on the units that you want to look at, and then you're 2 clicks away from investing. The first click takes you onto the detailed information that was produced at the time of the original loan. Auto bid, you can now bid at around the maximum rate that the borrower has agreed to pay. So if the borrower has said, I'll take an auction provided the interest rate is no more than 11%, you can lock in on your 11%, or you can say, I want 1/4% above that, or 1/4% below that. So that's quite an efficient way of effectively adjusting to the interest rates in the market from time to time. So could I ask you to get involved in this? I really, really want to make a loan in Dorset. You can lend as well. Thank you.